Welcome to the Investopoly podcast. Our goal is to share easy to understand, evidence based, holistic insights to help you master the game of building wealth. My name's Campbell Wallace, and I'm going to be jumping into some listener questions today. And for those listening at home, just FYI, we're at about January in terms of the questions that we're answering. So we're a little bit behind, but we are getting through them. There's some really great questions here that I'm looking forward to getting into. So the first one is from Marjorie. So Marjorie is 55 years old and she's planning on retiring in 3 years at 58. She has a 22-year-old daughter, adult daughter, and also her elderly mother lives with her. And she's given a breakdown of her situation here. So she owns her home outright, no debt on that. She has an investment property worth $500,000, but with debt of $380,000 against it. And then in terms of other assets, she's got a super balance of $850,000, cash of $250,000, and shares or ETFs of $50,000. And she's mentioned here that her current income while she's working is about $130,000, and her yearly expenses, which general living expenses, I'll take it from that, are about $60,000. So pretty low level there, which is good. I'll come back to that in a second. So in terms of the plan, she's thinking, well, of the $250,000 cash, and this is the plan that she's working towards and wants our opinion on. $250,000 cash, she's thinking about leaving $150,000 of that in a high interest savings account and then putting the other $100,000 into the ETF portfolio. She's salary sacrificing up to the concessional cap into super each year and will do so for the next 3 years before she retires. And super's invested in a high growth option. I'm not sure who with. Really, the first question is my plan on track with me retiring at 58 years old? And look, Marjorie, in my opinion, I think it is. And really, it just comes back to, your general living expenses. If they're 60,000, then that's the thing that makes me think that you're on track. And I think you're in a pretty good position. If you add up your super, cash, and shares together, that's about 1.15 mil in liquid investment assets. And that's not even including the investment property. So let's put the investment property to the side for a minute. But you've got 1.15 mil in liquid investment assets. I think you've got enough there outside super to see you over the 2 years, having 250,000 outside super to get you through that 2 years before you can access super at 60, that's no problem. And the way I like to think about this, Marjorie, is, what return would you need off that 1.15 mil of investment assets, not including the investment property? What investment return would you need from that in order to support 60,000 of income or capital gains, doesn't matter, overall performance per year to maintain the capital and support your retirement needs? And so the answer is it's about 5%, 5.2%. That's the annual return that you need from your shares, super, and cash overall per annum in order to just live off the performance and maintain the capital. So I like to use that as a very simplified thing. You simply just divide 60,000 by the 1.15 and that gets you to your 5.2%. That's the return you need to live off. It's very simplified, but really there's going to be no tax in this, so you can exclude that. If you count it as a net return after expenses and fees of like a super fund and share portfolio, that sort of thing, that's fine, still very achievable, 5.2%. And I think that doesn't even factor in diluting the capital. It's okay to dilute the capital as well, but I like to, when we're working with clients or looking at someone's situation, very simple, easy approach is just looking at, well, how much is the returns that we need in order to live off the capital? But you can dilute capital. That's totally fine. It's interesting, just as a bit of a side note, Marjorie, I'm reading a book at the moment, just about to finish it. It's called Die with Zero by Bill Perkins. It's an interesting book, and his methodology or belief system in sort of, I guess, financial and retirement planning is you shouldn't die with anything. You've overworked or you've oversaved and you've worked too hard and then haven't enjoyed yourself enough. So the aim of the game in life should be to die with zero. I mean, I don't fully agree with that. I like to have a lot more buffer in it, and certainly for our client, they like to have inheritances and leave something at the end, and and it's a bit of a fictitious sort of theory in dying with zero. You can never get it perfectly to that amount, but the idea is that why go to the grave with all this money when you could enjoy it? So I don't know, maybe it's shifted my opinion a little bit on it, and that I'm comfortable with some clients perhaps diluting capital a little bit, but even better if they're in a position where we think that the performance returns of the overall assets is just going to maintain the capital, then I think that that's a great outcome as well. But necessarily if you have to dilute some capital, it's not the end of the world if it's small amounts. So the other thing here is the investment property, Marjorie. I mean, I've kind of excluded it from that last calculation that I've done, but so it's worth 500,000 and there's a mortgage of 380,000. So the big question in my mind is, what's the rental yield on that? What's the rental income? And really the reason I'm asking that question is what is the overall holding cost on that property? So I'd take it a guess and say a property like that's probably a unit or apartment tend to be a high rental yield. So maybe up to 4-5%. I'm totally guessing here, but a lot of them are, but I don't know your one specifically. The key thing that I'm thinking in my mind is there going to be a holding cost for that investment property? I hope there's not. So, I mean, off some rough numbers that I've done, if we work off the simple assumption that it might have a 5% rental yield, then that would be about 25,000 per annum in rental income. Now, obviously, there's property expenses, maintenance, rental managers, all that sort of thing. So I'm going to shave about 30% from that. So that brings you down to sort of net rental income of about 17,500. And if I then think about, well, what's probably your interest cost, your holding cost on the loan? If we look at 380,000, assume just roughly a 6% interest rate, that's interest of about 22,800. So there's a bit of a gap there, and that gap is in the realm of about $5,000. So for me, I mean, again, I don't know your property, but just doing some rough numbers here, some assumptions, I think there's probably a 5,000 grand holding cost by holding that property. So that's the case. I don't think it's a big holding cost, to be honest. I don't think that that's major. Pretty much, I'd just add it to your general living expenses. So that means you need 65,000 rather than 60,000 per year in order to cover the costs of that property. So look, I think, adding that into the equation as well, I just wanted to explain how I'd look at it from a high level. I think you're looking fine. Marjorie's next question is there any alternatives that I could invest that 250,000 cash in? So her plan was to put 100,000 of it into an ETF portfolio and then leave 150,000 in a high interest savings account. Honestly, no, I like that, Marjorie. I think that that's the right way. You can get, decent interest on a high interest savings account at the moment. It's one of the benefits of higher interest rate environment. You can get sort of 4.3, maybe 4.5 even with some banks in a high interest savings account. So, and I think you want to have some money, that 150,000. I think I'd like that as well, to have that parked in cash just to live upon in those first 2 years before you can access super. And I think it's the right amount then, splitting 100,000 out into investing. And then in terms of, alternatives of what to invest that 100,000 in and what you've got your existing 50,000 in that ETF portfolio, well, that's really a whole can of worms. But look, at a high level, as long as you are taking those ETFs, low cost, passive, diversified, varying forms of indexing methodologies to it, a lot of what we speak about in this podcast, and hopefully you've listened to a few of the ones that we've covered in the past about how we'd approach constructing an ETF portfolio. But as long as you are doing that in a risk-adjusted way, then it should work for you. And Marjorie's final question is, do you think I'd benefit from engaging with a financial advisor? I don't think so. No, honestly, Marjorie, I don't know if the value is going to be there. Certainly wouldn't be for our services, but that's, that doesn't speak for everyone's or all other practices and firms. But I don't think so. I think you've done most of the legwork from here. I think I like your plan as is. The super fund, as long as, I'm guessing you're in some like an industry super fund and you've got that in their high growth option, which is managed in that. And as long as you're taking a fair approach to the ETF portfolio based off some research that you've done, I don't see huge risks in it. And I think it's pretty set and forget. So I don't think the value is there. I think you can do it on your own. You've done a great job. So well done. The next question now is from Ryan. That's what he'd like to be referred to as. Give some great feedback about the podcast. Thanks, Ryan. So Ryan is a rural GP. So is his partner, actually. So he's only 38 years old, Ryan, and his partner's 32, who's a GP in training. So he's got a good income here, Ryan, as you would expect. So the salary, he says, is about 350 to 400,000. His partner, who is in training, the salary at the moment is about 160,000, but once qualified, that'll bump up to about 200 to 250,000 in the next couple of years. And then the same as him, sort of get up to that sort of 350,000 from then onwards. So really, in the next few years, we're looking at combined incomes of about 700 to 800,000 in terms of family income from employment. So a really strong income there, looking good. And in terms of their assets, so they're living in an apartment in Darwin, which they bought, and so they think it's worth about 550 to 600,000. There's 340,000 owing against it. Then they've also got an investment property in Broome, Cable Beach, which is a sort of 700 square meter block, a 3-bedroom house, worth about 550 with about 350 owing against it. And then they've also got a property in Jindabyne, a single bed unit, which is worth about 540,000 with 510,000 owing. I'm guessing guessing from the timelines here that that was the most recently bought one, I would assume. And then we've also got bits and bobs, so 30,000 in crypto, 60,000 in direct shares, 130,000 in ETFs, as well as some very other small 5, 10 grand investments in small businesses, which are largely illiquid investments, that sort of thing. And then about 100 grand in offset. And so Ryan's plan, as he outlines it, is to, maximize the equity on the Darwin property. So use the equity in order to purchase an investment property in Brisbane, looking around the 1.3 mil mark. Then also don't look to liquidate anything else and keep steadily trickling some money into the ETFs. Then in a few years, he plans to do some minor improvements to the Broome property and then sell it, and potentially use the accrued equity in the new Brisbane property to put towards their dream home, which he thinks is likely to be sort of a coastal small acreage worth about $1.5 to maybe $2.5 million. And I guess by that he means use the equity, not sell the Brisbane property, is what that's outlining. And so Ryan's question pretty much is, what are your thoughts on the strategy, and what should I take into consideration, and what are your comments? So Ryan, looking at the numbers, just adding these together, so you've got just property alone, worth 1.64 based off the conservative end of your valuation. So total property position 1.64 mil, then total debt position of 1.2. So it's about a 73% loan to value ratio at the moment. Look, broadly speaking, I really like your aggressive approach here. I think at your age, 38, and your partner's younger, and given your occupation as rural GP and your partner's getting qualified to do so as well, I think it's, at this stage of your life and career, it's use the income to leverage up. So I don't mind at all you really sort of borrowing, taking all the equity you can from different properties and leveraging up to go for. I think it's not a crazy thing for you to do at all, and that's probably what I'd be doing as well, and what I'd be recommending for my clients to do in your position. This stage of your path or your career or wealth accumulation journey, it's all about leveraging up, using your income to leverage up to secure the big assets, to then get you in a position whereby, and then in 20 years' time, perhaps that's when you start looking at, well, maybe 15 to 20 years' time, that's when you take a bit more of okay, we've got to start consolidating here, sort of winding things back. But no, at this stage, I like your approach of sort of gearing up and using the equity in the properties. And your plan checks out in terms of that initial step with buying the Brisbane investment properties. So yeah, I think you'd be able to go and borrow 1.3 mil on top of what you've already got in debt. So add 1.3 mil to the 1.2 that you've already got. I think your incomes would check out for that. And certainly even if you just waited a little bit longer for your partner's income to increase, then you'd easily would. But even in current state with your income, yeah, I think you'd have no problem. So that plan checks out that you could do that in buying the Brisbane property. And the other thing I really like here as well is that, you've got all of your properties, maybe excluding Darwin, but the rest of them investment properties are regional, quite regional properties. So I like having the mix in there of going for something in Brisbane, kind of blue chip area in Brisbane, if you've mentioned it. So I think that's a good mix in your portfolio and the next sort of step to go towards. So I like that as well. My only concern here perhaps is that then I was liking it all the way along until I read, but then we want to buy our home, the dream home. Not quite sure what the time frame is, but it could be anything from 1.5 to 2.5 mil, and then the idea is kind of selling Broome and then using the equity in this new investment property to go and buy that property. I always just get a bit nervous with that, and I just wonder, there's a lot of pieces in this jigsaw puzzle that kind of need to work in doing that. What happens if, I don't know, Broome doesn't sell, you don't get the equity from that, or what happens if the Brisbane property in the next few years, I think is your timeline, doesn't go up as you want it to, and then you kind of then used up all of your borrowing capacity and you leveraged yourself up higher to the point where then you've pushed back or delayed, or you'd have to delay that opportunity to buy that dream home. I know we're really big advocates of trying to buy that dream home as soon as possible. And look, it could work in theory how you're going about it, because your incomes are going to increase and then hopefully you get the equity increase in this new Brisbane property. But it's all pretty short term and tight. I just wonder whether maybe it's not the Brisbane investment property, and whether you look to buy that dream home, lock it in sort of as soon as possible, because you wouldn't be too far away from doing that. You could go and buy an investment property 1.3. I think probably with a bit of maybe paying down of debt, maybe using some of the cash to do that, or maybe in a year or two, you'd be pretty much in a position to buy something for 1.5 to 2 mil for that dream home, as you've outlined as the target range. So, I'd think of it like a year or two maybe away from being able to buy the step 2, and then you can just avoid having to do step 1, which is the Brisbane property. It'd be good to add the Brisbane property to the mix as well. But, I think, the risk you run is that you do the Brisbane property as a stepping stone, but then that stepping stone retards your ability to get to the final end goal, or I'm assuming it's your final end goal, of buying that dream home. So some rough numbers I've just run here, and this is my thinking, just to show how far away from doing that step two, the dream home, are you, if this is, really the goal. So with the properties of 1.64 mil, being a medico, there are some avenues available whereby you get to borrow at a higher loan to value ratio. So that could, for you, being a medico, be up to 95% with some, you've got to have a good mortgage broker that knows those arrangements with certain banks, but you can borrow up higher to like a higher loan to value ratio. And 95% loan to value ratio on the properties that you have, you could borrow up to have access to equity up to about 1.558 mil. So then if we then take into account, okay, well, what's the current debt? You've got to subtract the current debt that you have of 1.2. It leaves then available equity of about 360,000 of available equity that you could actually use across all three properties. Now, just a comment here, just to clarify that you would avoid doing any cross collateralizing of loans by just setting up separate loans. So it's okay to have, as long as there are individual loans secured against one property, you can still put together a deposit across multiple properties, but by having individual loans secured against each of those properties. That's okay, just wouldn't want to set up a deposit loan secured against three properties. I don't think that's the ideal way of structuring that loan if you were to go down that route, just to make that comment. So if you think about that 360,000 odd of available equity that you could use, well, if that then constitutes a 20% deposit, well, that property that you could potentially purchase would be in the realm of about 1.7 to 1.8 mil. So you can see you're getting pretty close to that sort of range of that dream home of 1.5 to 2.5 mil. And, with a year or two, there's probably a little bit of a serviceability squeeze on there at the moment. But I think as per your partner's going to be getting qualified very soon in the next couple of years and their income's going to go up. I mean, this is only just a matter of time. You'll continue to build your equity through growth, but also through savings in offset account. And then your incomes in a pretty short period of time should be enough to get even higher in terms of that purchase price. So I just kind of think within the next couple of years, you're probably going to be in the realm of buying something for the midpoint, which is about 2 mil of that dream home sort of price range that you're looking at. So I just wonder whether I'd be having the consideration about, should we just wait a year and then skip the step of the Brisbane property, get that home secured? And I reckon if you do, there's probably, given how young you are and your income and your asset position, there's probably going to be another investment property later on. But securing that dream home as soon as possible, which I don't know where that is exactly, but I think that might be at least something to consider for you there, Ryan. So I'd work through that exercise with your mortgage broker, holistic mortgage broker. Hopefully you do have one. Work through those sort of scenarios with them to get an understanding of then sort of timeframes, and at least then you've got an informed decision to make around the next step. But that's the only thing that I'd mention. Otherwise, I generally like your approach, Ryan. You're in a great position, and I agree with most of the other points in your plan that you've mapped out. Best of luck. The next question now is from Brett. So Brett is 35 years old. He owns his own home, which is a farm, 300 acres inland from Port Macquarie. And sadly, Brett's been involved in a multiple trauma accident at work, so a very severe one about 6 months ago. And he writes that he's been unable to return to work yet. It could be another 12 to 18 months before he can. He's had multiple surgeries. There's a couple more surgeries to go. So look, he thinks really he's in a transition phase at the moment. He says that he doesn't think he'll be able to return to the physical job that he's done his whole life. So he might have to learn a new skill or start a new career. And so for medical reasons, to access medical services, his plan is to sell the farm, which is worth about 1.9 mil, no debt on it, and move into Port Macquarie where he's got closer to services there and just rent for the time being whilst he's undergoing these surgeries and whatnot. But look, luckily Brett is in a strong financial position. He goes on to mention that he's got 5 investment properties in total worth about 3.3 mil with 1.5 mil of debt against them with about 100 grand in offset accounts. So, we're talking roughly a 50% loan to value ratio, roughly 1.6 to 1.7 mil of equity across his investment property portfolio. So that's looking good. He's also got a share portfolio worth 370,000. So his plan in the near term is when he sells the farm for 1.9 mil, offset all of his debt against the investment properties, which then with no debt against them, he believes will produce about 78,000 of income, plus from his share portfolio, which he'd tip a little bit more into, he'd have then about 15,000 of income from the shares. And he thinks that should be, that combined sort of, what are we getting to, about 90,000 odd, 85, 90,000 of income is enough for him to live off for the time being. So that's what he's thinking at the moment. And so Brett's concern here is that he's worried that the property markets are going to price them out over the next 5 to 7 years. whilst they're sort of renting and sort of holding their current position. They don't really know where they want to move to in the future. So buying the forever home early, like we often talk about, isn't really an option right now. They have some vague ideas, maybe somewhere in Byron, Gold Coast, hinterland region. And then they think maybe they're really not sure, but the type of property that they'd want to buy might be around the 2 mil mark. So pretty much kind of pretty close to replacement value of their current farm. And pretty much just for the time being, he's trying to work out, he's worried about getting priced out of the market and holding court for the moment and working out what's the best thing to do with his cash in order to keep up with property prices while they rent. So he's mentioned here, after offsetting the debt, or vast majority of the debt, with the remaining roughly 600,000 of proceeds after selling the farm, he's thinking about then what to do with that, and he's considering putting it into a resi and commercial property development just as a money partner with a developer where they pay 16% per annum at completion as sort of, so I'm guessing it's sort of like a syndicate or a scheme pooled arrangement in a larger development, considering doing that with about 600,000 of the excess proceeds from the home. So, Brett, I don't think I'd do that. I wouldn't go taking 600,000 of that proceeds from the home and putting it into that property development that you're speaking about. I think you need liquidity, particularly while you're in a period of not working, uncertainty. You need to have liquidity, and that's a very high risk strategy. You've mentioned it yourself. I mean, anything that's sort of spooking 16% returns per annum, that's a high risk strategy. And it's also, you're going to lose access to your funds. You lose liquidity, which is a big thing. So I definitely wouldn't recommend doing that. And then in terms of then what you should do, I think it's fair to offset some of the debt. So with the 1.9 mil that you've got, so I'd probably split it in half, roughly. This is just rough thoughts, but you don't need to pay off all of that debt. The 1.3 mil owing against your investment properties, which are worth 3.3 mil in total, we don't need to go paying all that down. You know, paying down investment debt's not that great a return on investment, to be honest, because it is deductible debt. Granted, you don't have an income at the moment, but I think I'd be maybe splitting it maybe half. So I'd be putting about 900,000 in the offset account, having huge buffer there. That's safety. That's your emergency buffer in offset account. And then the other mil, maybe you keep, well, you've already got all that cash as your buffer, but maybe you could keep another couple 100,000 just as another separate buffer. But then we're still leaving about, close to 900,000 here that I'd probably go and invest. Because really, if you think about it, even if you sort of just keep renting in Macquarie for the next 5 to 7 years as you just work out what you need to do in your career change, you've got, over a mil in an offset account. The property portfolio should be cash flow neutral, even if cash flow positive, I'd say, given the level of the value and how much you're offsetting, and the net debt is quite low. So I'd try and get that property portfolio to about cash flow neutral, maybe a little bit positive, but don't offset all of the debt. But then I'd go and invest some of the remaining. Keep yourself about 2 years, maybe even 3 at most, cash buffer, just in case. But then I think that's the way you keep up with the property market. And the thing is, you've got 5 investment properties worth 3.3 mil. So I don't know whether they're in Port Macquarie, but actually it doesn't really matter, because usually we try and if you're invested in something, you're offsetting the growth in that market because you're getting the uplift in your property. So in theory, it's kind of an offsetting play if you're in the same market. But the thing is, I don't know where your other 5 properties are, and you don't even know where you really want to end up living at the moment. So look, broadly, I'd hope that, you've got some good properties in that portfolio. They're diversified. And if the areas that you want to buy into are growing, well, in theory, then hopefully your property portfolio should be growing as well. So my point here is, hopefully you should be hedged somewhat against general property growth, and I don't think you'll get priced out of the market. And so I think then if you're putting a fair chunk of that other assets to use in the share portfolio, park a decent lump sum of money in the offset account, just so you're spitting out a bit of rental income from your property portfolio. I think you'll keep up with it. I think the properties, I don't know where they're all located, but I hope they continue to grow, and your share portfolio would continue to grow roughly in line with the property prices of the place that wherever you want to end up. So I don't think that's too much of a worry. I think if you're invested, you should be okay. And I think you'll be in a good position once you eventually make up your mind of where you want to buy. And look, worst case scenario, if something in 5 years comes up where you go, okay, this is where we want to live, it's come up and there's a house here and it's worth 2.5 mil, for example, and so that's a little bit more than what you sold your farm for 5 years ago. Well, then if you need to sell one of the 5 investment properties in order to make that work, in order to buy that home debt free, well, then you're left with the home debt free. You know where you ended up. You've got 4 investment properties, not too much debt against it, share portfolio of over a mil. You're looking pretty good, I'd think.
So, next question is from Matt, who has a question about family trusts and corporate beneficiary. And this is a good question here. It's one we've worked through a little bit internally a couple of times, so it might be applicable for quite a few people. So, the question he has is the cases that a family trust holds investments with a corporate beneficiary. So, just to explain this for everyone at home, that there's investments within a family trust, and then one of the beneficiaries of that family trust is a corporate beneficiary, which is a company which can receive, like an individual would, but can receive the income. And as Matt's mentioned here, then the company pays tax at a flat rate of 30%. So for a lot of people, distributing those income from the family trust to the company, capping at that at 30% is better sometimes than going to individuals if there's no individuals on low tax brackets. He mentioned here that the shares of that company we have mentioned that the shares of that company should be held by the family trust for flexibility. Yes, that's right. So the idea then is that the company's shares, so when the company then eventually goes to pay out dividends, they can have then pay it into a family trust, and then that family trust then has flexibility in who to distribute the dividends to, the dividend income to. So, you're sort of using the company, park it there. When dividends eventually paid out, it doesn't have to go to a set people that are the shareholders, for example, 50% to husband, 50% to wife, for example. Instead, you pay it into a family trust, and then that family trust can then have flexibility every year in how they distribute those dividends from that company. And so Matt's question is, should that be the same original trust that holds the actual investments, or a separate or another discretionary trust that has only the persons involved as the beneficiaries? So he has been advised to use two trusts. So to have family trust as the original holder of the investments, then the corporate beneficiary, then a second trust, and then the second trust has all the beneficiaries. And he says this is to avoid falling foul of ATO rules, but he just wanted to understand because, there's additional costs involved in having a separate family trust. So, Brett, that's how I'd go about it. I hope that's helpful. And look, best of luck to you. Sorry to hear about your medical health at the moment, but look, best of luck. The short answer is no, you don't have to have a second trust. It is perfectly fine to have just that trust A, even though it's a bit of a strange sort of circular loop, it might seem like if you map it out in an entities diagram. There is no problems with the corporate beneficiary, the shares in that corporate beneficiary being owned by the original trust. There's no problems there. So you can do that. There's no problems as well having the second trust. In theory, for the vast majority of years, the trust is just going to have no income being distributed to it, the second trust. So it's just going to produce a nil return. It's probably not going to cost you a whole lot. So it's not a big deal either way. Some accountants do argue the position that, it's safer and more conservative from an ATO ruling perspective to have a totally separate trust as the shareholder. But equally, I've seen it work perfectly fine just with the same trust, having it loop back into it. So there's no problems with doing it. You can do it either way. I'd probably do it just by having the one trust. We've probably got time for one more question here. So, a question is from Bay, as they'd like to be referred to. So, Bay did a development down in Frankston. So Bay bought a 1,300 square metre site in Frankston for 1.3 mil and then completed a 4 townhouse development, build cost of about 1.5 mil. Mentions here that the gross rental yield across the 4 townhouses is now 5%. So that development's done. That Bay now owns sort of 5 townhouses down in Frankston, which Bay mentions location strong, walkable to the beach, shops, train stations, it's zoned well for public schools. However, despite this, a recent bank valuation for all townhouses came back at approximately 3.6 mil, and Bay mentions that once all costs are accounted for, the overall return has been disappointing relative to the risk taken. So as you can imagine there, from those valuations, plus all the other costs added along the way, not a lot of margin there, I'd be imagining. But anyways, Bay's now weighing up a few options and what our view on it. The options are really, as Bay puts it, should I sell all 4 townhouses, exit completely and redeploy the capital into a more investment grade property in Melbourne? Should I sell enough townhouses to recover the cost base, then redeploy the capital? So sell some of them, or would you consider holding them all through Melbourne's next growth phase, which we've spoken about and Bay refers to here, given the location, even though development margin's already been realised? Bay goes on to ask the questions and makes the comments around, who would you use in terms of, assessing where to buy in terms of the next step, the next property, be it a property specialist, local buyers agents, that sort of thing. For context, Bay mentions that these townhouses are owned in a family trust and land tax is about 20 grand a year. Ouch. And then there's about 860,000 of debt remaining against it. So the question is, what would we do? Bay, look, it's going to be really hard, and this is not specific advice. Of course, this is just information only, so I'm going to have to speak generally. I I don't even know where these properties are located, haven't looked at them. I know you've mentioned they're in Frankston in Melbourne, but look, I don't know. I just think any margin that you've made, when you split up a big block like that, some developers think then that you're still going to get the same level of underlying capital growth from that overall block than you would have by having that original block. And I don't think that you do. I think once you split it up, you've then changed the nature of the asset, and then you can then expect a different level of capital growth going forward. So I don't think, but more just from a diversification perspective, I just don't think holding 4 properties that are exactly the same in exactly the same location and tying up all your capital in that is a smart call. So I would be taking some of your capital out of it. I would be, maybe you keep 1 or 2. I'd be getting rid of at least half of them, taking any profits that you've got and redeploying it into another asset, taking a bit of a different approach, maybe going a little bit more inner city, a little bit more blue chip area, getting something again which has high land value components, got some good scarcity to it. So perhaps something like, period home, something that can't be replicated in a good area that's got, enduring demand. It's a desirable area from, aspirational parts of the demographics, if I can put it that way. And so I'd be looking to redeploy it. And I don't think there's any circumstance where I'd be keeping all those. I think the nature of these developments is you make your growth in the development, and then I think you sort of exit after that. I don't think that holding all 4 of those townhouses long term is going to be the best decision. So again, this is just general. I don't know those properties exactly, but that's what I'd be thinking. Maybe you keep 1, maybe 2 of them, but I'd be looking to go elsewhere. And then in terms of then who you get some advice on, so a trusted buyer's agent. I don't want to get to the point of naming either individual people or practices, or we don't really like naming specific products and that sort of thing on this podcast. But speaking generally, really we're really big advocates of using buyer's advocates, buyer's agents, so local property specialists. Perhaps if you want to reach out to us individually, I could help you in terms of who we might consider and who's a good person to speak to, perhaps. But look, getting someone to help you go in and buy a really good asset and then put you in a really great position for whenever it comes, the growth cycle in Melbourne, whenever the tide turns, I think you put yourself in a good position there by using someone of that nature. And Bay, if I could just make a final comment, just about sort of these developments, subdivisions, putting 4 townhouses, that sort of thing. It's really stretched the margins at the moment. What we're seeing, we see a lot of clients come to us with, these proposed plans of developments, and, the classic subdivision, put 2 townhouses. We've seen a lot of them in sort of the southeast suburbs of Melbourne, a lot of them put in that area. There is just not a lot of margin left in them. And I think, gone are the days, I thought, well, maybe it's just a case of at the moment, whilst construction costs are really high, hopefully they don't go any higher with everything that's going on around the world with supply chain problems. But, it's really squeezed at the moment, those margins on small scale developments like this, knocking up 2 to 4 townhouses. So we're not seeing a lot of them work or really be worth the time and effort in doing it from the assessments that we're doing for a number of clients internally. So that's just a general comment for you, I guess, and for anyone else. But I think maybe perhaps at the moment it's just with construction costs being where they are and holding costs being where they are as well. Maybe it's time that you take what you've got out of that and then move it into a more long-term passive traditional type investment where it's just a long and hold, and let organic capital growth do the work for you in a good asset and hold it for long term. Perhaps might be a time to take that approach for the next step. I hope that's helpful, Bay. Okay, that's probably all I've got time for today. We got through a few there. Would have loved to have got through a lot more. But until next time, bye for now.
And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.